after today's announcement, there is going to be a lot of talk about trigger points and trigger rates. And I want to explain those because there is a lot of confusion out there. First of all, this does not apply to you if you have a fixed rate mortgage. Second of all, this does not apply to you if you have an adjustable rate variable mortgage. So that means a mortgage where your payment changes each time the Bank of Canada changes the overnight lending rate. If you have a variable interest rate mortgage, that means a variable mortgage with a static payment, you may be approaching your trigger rate. So what is the trigger rate? That is the point where your mortgage payment is only covering the interest portion of your mortgage. That means you're not actually reducing the principal anymore with your payments. And that may happen to you if you originated your variable interest rate mortgage when rates were about 1.5%. Now rates have moved up into the 4.5 to 5.25% mark. So you are looking at a trigger rate. That means you may be in a situation where each payment is not actually reducing your principal. Now, that's the trigger rate. There's something totally different with the trigger point. If your mortgage was an insured mortgage and you are no longer paying down the principal because you originated your mortgage in a variable interest rate mortgage when rates were closer to 1.5%, you may be in a situation where you actually are in a negative amortization. That means that you're not paying enough on your mortgage to be decreasing the number of years that you will have your mortgage anymore. Your trigger point won't hit until you are at 105% of your original mortgage amount. If you have a conventional mortgage, meaning you had 20% or more down, your trigger point will not hit until you are in a situation where you're at 80% loan to value, meaning your mortgage is 80% of the value of your home, okay? So there's two different conversations, trigger rate and trigger point, and it is only applicable to Canadians with variable interest rate mortgages. That means Canadians that have a variable interest rate, but a static mortgage payment that doesn't change, okay? Really important to know if you're in that category or if you are not. There are millions of Canadians with mortgages and a very small percentage of them with variable interest rate mortgages. If you are in this situation and you aren't sure what to do, the first thing I would consider doing is taking a quick look at your budget and seeing if there is an extra $100 to $200 a month that you could add to your mortgage payment. This will help a lot. It will keep you out of that hot zone where you might be getting into a situation where you're starting to move towards your trigger point. If you can't do that and you need to rework your mortgage, maybe you need to increase your amortization, maybe we need to relook at cash flow, it's super important to reach out to your mortgage broker and make sure that you understand exactly what all of the options are. They are going to be different for every single person. So very important that somebody does a particular cash flow analysis on your specific financial situation so you know exactly what to do.